All right, everybody. Welcome back to Strongman Personal Finance. Today we're going to talk about stocks. So let's break this down Barney style. What is a stock? Pretty simple. If you buy a stock, you own a part of the company. So if I buy a Microsoft stock, I own a small sliver of that company. Why do companies issue stock? They need money. All right, a company can get money several different ways. They can go into debt, pay interest on that debt, or they can give up part of the ownership of that company to stockholders. They give you a stock, you give them money. All right. If you own a stock, you actually have voting rights. So the company has a board of directors, and the board of directors are the people that declare dividends. They oversee the senior management of the company, and they appoint the senior management of the company. You actually get a vote to select the board of directors of whatever company you own stock in. So you actually have a very small amount of influence in that company. Now, if you own just one stock of Microsoft, you're not going to have any influence, right? But if you own 40% of a company, you have much more influence. You have significant influence. You can select whatever board of directors you want, and then those board of directors help guide the management to achieving the company's goals, all right? So you actually can vote if you own a stock. Now, how do you make money from stocks? There's two ways. You either get a dividend that is declared by the board of directors and then paid out to you, or the stock appreciates on the stock market. Dividends, pretty simple. It's the company paying out their profits to you. You own the company, you eventually get some of the profits of that company. How it works, the company makes money, they have expenses. Whatever's left over after they pay their expenses, taxes, interest, all that good stuff, goes to an account called retained earnings. From the retained earnings account, the board of directors can choose to declare a dividend. And what that means is they're going to take money from that retained earnings account and they are going to pay it out to all the stockholders, or mostly all the stockholders. Depends on the situation, but we're not going to go there right now. So that's one way to make money from a company. Company pays you dividends. You get income from the company just by owning the stock. You don't have to do anything. You just own the stock. The other way is appreciation. Now, everybody knows what appreciation is. You watch the stock market, prices go up, prices go down. That's appreciation. If the price of the stock goes up and then you sell that stock, well, you've realized a gain. You have to pay taxes on that gain, but you've realized a gain, all right? So you can either get paid through dividends or you can have capital appreciation and then you have to sell your stock. Now, a key thing to keep in mind is that if you own a stock and then the stock price goes up on the stock market, if you haven't sold that stock, you haven't realized any gains. You have a paper gain. You only realize a gain and a loss when you sell the stock. Hopefully that makes sense. All right. Stocks are traded on exchanges, they're traded over the counter, but mostly all the big stocks that you're going to think about buying or considering to buy in the future, those are traded on stock exchanges. There's not one stock exchange. There's not one stock market. There are multiple exchanges and there's multiple stock markets, which we'll get into in a bit. All right. Stocks are volatile. What does that mean? Stocks can fluctuate rapidly. If the economy goes to crap, a lot of stocks are going to go down in value very quickly. If the economy is doing great, stocks tend to skyrocket pretty dramatically. It all depends on what phase of the market cycle you're in. All right. So owning a stock, there is some risk involved. All right. But that can be alleviated by diversification and by investing according to your time horizon. Now that leads us to our next point. Should you buy stocks? All right. Stocks do not need to be a part of everybody's portfolio. It really depends on you. For example, your time horizon. Let's say you're 65 years old and you're about to retire. All right. Do you need a lot of stocks in your portfolio? No, you probably don't. Why? Well, like I said, stocks are volatile. So if you're about to retire and you have a large amount of stocks as a percentage of your portfolio, and then the market crashes right before you retire, you're losing a lot of money, all right? When you retire, that's the point where you want to start selling off your expenses so you can help fund your retirement. So if your time horizon is very short, it might not be such a good idea to have a lot of stocks in your portfolio. Now, if you're young and healthy like me, you're only 30 years old, and you're not going to retire till you're 62, well, that's okay. You can have a ton of stocks in your portfolio. You're able to weather the ups and downs of the market, right? Risk tolerance. Everybody has a different risk tolerance. What does that mean? That's how much risk you want to tolerate. It's pretty simple. If you don't mind your stocks or your portfolio fluctuating rapidly from year to year, then you have a pretty high risk tolerance. If you don't like seeing your portfolio fluctuate that much, well, your risk tolerance is a lot lower. Now, there's no one size fits all for everybody, okay? You can have a lower risk tolerance. That's fine. The only issue is you may not see as much growth as somebody that has a higher risk tolerance, right? But at the same time, you might not see such or larger losses. So it really depends on you. There is not a one size fits all thing to buying stocks, all right? You need to consider your goals when you're buying stocks. If you're saving for a down payment on a house that you're going to pay in 1 to 2 years, you should absolutely not put that money in the stock market. You're saving that money for a specific purpose. Your time horizon is short. You need that money to be in safe investments or just keep it in cash because you need that money very soon. If you don't need money for a long time and you just want to see it grow, then it's actually a better idea to keep it in stocks. All right. Hopefully that makes sense. When should you buy stocks? All right. There's really two methods to purchase stocks. All right, you can do dollar cost averaging, or you can try to time the market, which I don't recommend. All right, what is dollar cost averaging? Very simply, it's buying stocks on a steady schedule. Steady schedule. So, for example, if you contribute to your 401k, every month you're contributing a little bit of money to your 401k, and that money goes into buying stocks, bonds, whatever you're invested in. All right. So if the market's going up, you're buying stocks when they're expensive. They're going up and up in price. And when the market's going down, you're getting stocks on sale. All right. Every month you're purchasing stocks. Hopefully that makes sense. Or you can try to hold on to your money and you can try to time the market. Now, what does that mean? Now, when the market's going up and up and up and up and up, and everybody's happy and everybody's excited and everybody thinks they're rich, is that a great time to buy stocks? I would say no. When the market's crashing and everybody's panicking, is that a good time to buy stocks? Absolutely. Because then stocks are on sale. All right. It may seem counterintuitive. Why would I buy stocks when the stock market's falling rapidly? But it actually makes sense. They're just on discount. And if you look at the history of the stock market, over time it increases rapidly. There are fluctuations, but it does increase significantly over time. All right, another concept you should understand is that there's multiple stock markets. There's not one single place in the world where stocks are bought and sold. All right. For example, you got the big daddies in the United States. You got the New York Stock Exchange and you got the NASDAQ. The New York Stock Exchange is an actual physical place where stocks are bought and sold in New York. All right. There's a lot of digital transactions that go on there too, but there actually is a physical location where brokers gather together and buy and sell stocks. If you watch any movies, you might see a scene where a day trader is on a stock floor buying and selling stocks. That's probably the New York Stock Exchange, right? The Nasdaq, there is no physical location. All stocks on the Nasdaq are bought and sold digitally, right? But a stock you may buy in the Nasdaq may not be in the New York Stock Exchange. So there's different places where you can buy different stocks. Now, there's another thing you might see called indices, all right? The S&P 500, the Dow Jones Industrial Average. Basically, all these are is that they give you an indication of how the stock market is doing on any individual day. For example, the S&P 500, it's in the name. It tracks 500 of some of the largest companies in the United States. Now, if the S&P goes up one day, that means the majority of those companies probably saw increases in value. Whereas if the S&P 500 goes down one day, that means the majority of those companies probably lost some value that day, right? Now, it doesn't mean that if the S&P 500 goes down and you have a stock in the S&P 500, that doesn't mean that your stock lost value. It just means that on average, the majority of those stocks lost value that day, right? Hopefully that makes sense. Now, you may hear horror stories of people that lost it all in the stock market. The stock market's rigged and you're just going to get screwed over if you invest in stocks. All right. That's a bunch of BS. right? You only lose money on a stock exchange when you sell your stock. If I buy a Facebook stock, right, and it goes down 20 points in one day, did I lose any money? No, because I didn't sell it, right? If I hold on to that stock, I'm hoping that over time that stock will increase in value over time. So if that stock drops to 20 and then drops by 20 points and then it goes up by 50 points the next day, that also doesn't mean that I made any money. You only make money when you sell the stock. Hopefully that makes sense. All right. Now, what happens is the stock market will crash sometimes, right, as it tends to do. And what people do is they panic. They say, "Oh my God, it's the end of the world. Everybody sell your stocks. This is Jim Cramer, or whatever, told me to do." Right? When your stock goes down in value significantly, and then you sell it, well, you've locked in that loss. It's called realizing your loss. But if you actually just weather the storm and you wait out and you hold that stock, eventually it goes back up in most cases. All right. Not for all stocks, but for the market as a whole, the market usually goes up over time. So if you're one of those clowns that, panics and watches the news and sells your stocks whenever the market goes down, that's when you get screwed. Because what happens is you sell a stock when it's low and then you wait and hold your cash until the market goes back up. So you're selling stocks when they're low and then you buy them when they're high. And your gains are horrible compared to somebody that just held on to that stock for a long period of time. All right. And if you think about it, yeah, the stock market goes up and down. But on average, if you look at the entire history of the stock market, it's gone up by an average of 10% a year, which crushes inflation. All right. Savings accounts, bonds, they barely keep up with inflation. But the stock market, on average, has grown 10% a year since its inception. So if you really want a chance of beating inflation and getting enough money to actually retire comfortably, you're most likely going to have to invest in stocks. So no crap, there I was. I was about 25 years old, staying at a friend's house. I lived with him. I was in the military at the time. My friend was deployed, and I was in the backyard cleaning his pool. And at the time, I was studying to become a financial advisor. I was learning the sales tactics, taking the tests that you have to pass to become one. And I look over, and my friend's neighbor's there looking at me. I'm like, "Hey, what's up, man?" And he's like, "Hey, how's it going?" I'm like, "Oh, I'm just cleaning the pool." And he's like, "Oh, what you got going on?" I said, "Yeah, I'm actually studying to be a financial advisor." And then I told him the company that I was studying to be a part of. And he was like, "Oh my God, those guys are horrible. They screwed me over on the last stock market crash." And I was like, "Oh, what happened?" And he's like, "Well, they put me in stocks, and then those stocks went down like crazy, and I lost so much money." And I was like, "So you're how did you lose the money?" He's like, "Well, I sold the stocks." I'm paraphrasing here. And I was thinking in my head, I was like, "You are not intelligent, all right? You sold the stocks when they were crashing. So of course you actually locked in your gains. But if you had actually held on to the stocks, you would have actually made more money in the long term if you had just held on to them because the stock market went up pretty quickly after the last crash." But, I didn't want to explain that to him, hurt his fifis. But basically, you don't want to be that guy, all right? You need to be able to have the mental fortitude to weather the storms. Now, every company has market capitalization that's traded on an exchange. And what that means is that's just the total market value of that company at any point in time. Now, to find the company's market cap, all you do is you take the share price at the time and you multiply it by the number of shares that are outstanding. And that number is how much that company is worth at a specific period of time. Now, there's different categories of capitalization. You got mega caps, large caps, mid caps, small caps. And basically, it just kind of tells you how big this company is, right? So going into mega caps, the big boys, all right? Mega caps are stocks that have 10 billion or more of market capitalization, all right? You probably recognize these: Apple, Facebook, Google, et cetera, et cetera, all right? Now, a thing to understand about mega caps or large caps is that they usually pay dividends. Now, I explained dividends earlier as the company's paying out a part of their profits, all right? These companies are large, they're mature, they're stable. They do fluctuate in value, but they're not going to fluctuate as much as, say, a small cap. All right. Now, a way you track volatility is a concept called beta. And what that means is beta tells you how a stock reacts proportionate to a market or index as a whole. So if a company has a high beta, a stock has a beta greater than 1, for example, when the market goes down by 10%, well, that stock's going to fall by more than 10%. If the market goes up by 10%, well, that stock's going to increase by more than 10%. All right. So beta kind of tells you how the stock that you own is going to fluctuate based on the movements of the market as a whole. All right, or an index as a whole, whatever that stock's being tracked against. All right. Here we got mid caps, the middleman. All right. These are stocks that are between 2 and 10 billion in market capitalization. All right. Dick's Sporting Goods, Etsy. There really weren't that many companies that I recognized when I looked at a list, but I found a few that you might have actually been to or heard of before. All right. So mid caps, they're less risky and volatile than small cap stocks, but they're more risky and volatile than large caps. And if you think about it, the smaller the company, the more likely that company is to either explode in growth or fail completely. All right. McDonald's, which is a large cap or mega cap, it's probably not gonna fail. It's probably not gonna fluctuate that much in value. Whereas a company that's smaller, like a new company, that company has a much higher chance of failing completely. All right. Now, mid cap stocks, they may or may not pay a dividend. All right. A lot of mid caps, they're still trying to grow. So instead of paying a dividend, what the board of directors will do is they'll tell the stockholders, hey, instead of paying a dividend, we're going to invest these retained earnings in growing the company. So a lot of the times, if you own mid caps, you might get a dividend, you might not, but hopefully it's for a good reason. All right, and then you have the small caps. These are the peewees. These are stocks that have or companies that have a market capitalization of 2 billion or less. All right, they're highly volatile. They rarely pay a dividend, and you buy these for their growth potential. All right. Now, like I explained earlier, small caps, they're smaller companies. They are either this brilliant idea that's going to explode and become a multi-billion-dollar company, or the company may not be that great and eventually it fails. All right. But the risk versus reward is much greater for small cap stocks. So what happens is you're not really going to get dividends from these companies because the companies are investing all of their earnings into growing the company. All right. Hopefully that makes sense. Diversification. All right. I'm sure you've heard this before if you have watched any other personal finance videos, but basically all diversification means is that you're not putting all your eggs in one basket. All right. So if you put your entire life savings into one stock, you're kind of foolish. All right. Because if that stock, crashes or fails completely, if the company falls apart, well, you just lost your entire life savings. That is why mutual funds, which I'll talk about in another video, are the way to go. They offer you almost instant diversification, depending on what mutual fund you buy. But that's the point of most mutual funds, instant diversification. Instead of owning one stock, you own 10, 20, 30, 50, 100, 1,000 stocks at once. So if one of those stocks fails or falls apart, it's really not going to affect your portfolio, all right? So you have people that buy mutual funds like me, and then you got the day traders, all right? These are the clowns. These are the guys that, they go on the stock exchange and they're like shorting penny stocks and they're trying to find that one stock that's going to grow and make them, multimillionaire. They're a bunch of clowns, all right? Most people don't know where a stock is going to go. You may think a company's great, but there may be problems with the company that you don't even foresee. And if you're one of these guys that's on the exchange floor, betting his life savings on one or two companies, you're not very smart, right? Yeah, it may look cool, and every once in a while, one of these guys gets lucky and makes a ton of money. But in general, that's not what happens. A lot of these guys lose big, right? The safe way to go for the average American is to invest in low cost mutual funds that offer broad diversification. All right. Now we're going to talk about the growth between a savings account and the stock market. So I just wanted to illustrate to you how much the stock market can build your wealth versus just keeping your money in a savings account, which is safe. All right. So let's say, for example, that we invested $100,000 as a lump sum and we invested it for 30 years. We put it in a savings account paying 2% interest. And in the other scenario, we put it in the stock market for growing at 10% annually. All right. In your savings account, at the end of those 30 years, you're going to have $181,000. Whereas in the stock market, you're going to have $1 million. All right. That savings account is going to grow steadily over time and you're not going to have any losses. But at the end of the day, there's a huge disparity between your returns in a savings account and the stock market. Yeah, the stock market in those 30 years is probably going to go up and down and up and down. And people are going to tell you to sell your stocks when the market's crashing, and they're going to tell you to buy when the stocks are overpriced and expensive. But if you just held on to that stock and you actually realized that return after you sell them after 30 years, you got $1 million minus taxes. All right. But there's another thing to consider, and that's this thing called inflation, where prices of goods increase roughly every year. Usually it's about 2-3% a year in the United States, all right? So if you factor in inflation, well, your savings account's real value at the time after 30 years is only $74,000. So you actually lost money by putting in your savings account, all right? And I'll make another video, really going into in depth about present values and inflation and how that affects your portfolio. But basically, the dollar every year it gets a little bit weaker. It can't buy as much stuff. And, basically, if you don't invest your money in an asset that's going to give you significant growth over time, you're actually losing money in real dollars. All right. Look at the stock market balance. Yeah, it's not $1 million, but it's still $414,000. It's way more. It's more than 4 times of growth. All right. So it's good to have your money in the stock market, especially if you have a long time horizon. Hopefully that makes sense. And we got the history of the S&P 500. And this is just to illustrate, yeah, stocks go up and down. I mean, if you look towards the right side, you see, oh, there's one crash, oh, there's two. But over time, the market continues to increase and increase and increase. So don't be one of those clowns that sells when the market's at the bottom and then buys when the market's at the top. If you're young and you want to invest for your retirement, get some stocks in mutual funds and then just wait. Have patience. And last but not least, I implore you to like and subscribe my videos, okay? And if you don't, I'm going to cry. And you don't want that to happen. You don't want to upset me, okay? I really appreciate it. You guys have a wonderful day.